A $299 annual service agreement is considered the ideal recurring revenue stream for plumbing businesses. It promises peace of mind for the customer and predictable cash flow for the owner. But that predictability assumes a specific limit on service usage. If a single customer requests 4 dispatches in a year, the hidden operational costs of those visits begin to challenge the viability of that flat rate fee. And this is exactly the point where a predictable income stream meets the harsh reality of unmeasured field costs. To understand the impact, we must calculate the real cost of a single free service call. This includes fully loaded labor, physical parts, vehicle mileage, and fixed business overhead. As labor, parts, mileage, and overhead stack up with each visit, they eventually cross the $299 revenue ceiling. For this specific agreement, every subsequent call results in a net loss. While the math is clear, attempting to manually calculate these fully loaded costs for every single dispatch ticket creates a significant administrative bottleneck. For a bookkeeper, this means spending 15 minutes per ticket, cross-referencing mileage logs and labor rates to manually key a single journal entry into QuickBooks. Without an automated way to track these costs in real time, service agreements can function as invisible drains on a company's total profitability. Solving this requires a specific overhaul of the QuickBooks chart of accounts. We need to establish a precise data structure before we can apply any automation. We have to move away from generic expense buckets. Instead, use specific cost of goods sold accounts to isolate every dollar spent servicing these agreements. We break it down into 4 distinct 5100-level operational silos. We create account 5110 for labor, 5120 for parts, 5130 for the vehicle, and 5140 for overhead. Categorizing these factors is a prerequisite for the system. Without this separation, it is impossible to calculate true per-customer profitability. This structure allows the accounting software to receive automated data payloads directly from our custom script. Establishing this granular data architecture is the mandatory first step before any AI logic can be applied to the ledger. Next, we move into the Python environment to build the automated bridge between the field dispatch software and QuickBooks. The process begins with the incoming data payload. This captures raw field inputs from the technician, including hours worked and parts used on site. We then use prompt engineering to define Claude's role. We specifically instruct the API to process the field data as a professional cost accountant. We program the prompt with rigid mathematical rules. Claude is commanded to multiply the raw hours by loaded labor rates and calculate overhead based on a fixed percentage. The system takes that chaotic field data and converts it into a structured output, with every cost factor calculated and itemized. The final step is mapping all of these calculations into the specific journal entry format required by the QuickBooks API. A very common technical error here is passing text-based account names, like SMA labor, which the API will simply not recognize. The API requires a specific integer ID. Passing the numerical code 5110 ensures the transaction posts successfully to the corresponding labor account. Claude acts as the translation layer here, taking messy operational data and turning it into a rigid accounting entry. In a live environment, the Python script triggers the moment a technician closes a dispatch ticket in the field. Claude executes the itemized math and pushes the completed payload to the QuickBooks API in a single transaction. Fragmented digital data from the field instantly clicks into place as a perfectly balanced record within your books. Inside QuickBooks, we see the result, a generated, flawlessly balanced journal entry that correctly categorizes every dollar of the service call. This replaces a 15-minute manual bookkeeping task with a 3-second automated process. On a macro level, the business now has a real-time view of profitability for every single service agreement customer. This data allows an owner to make informed decisions on multi-level pricing tiers, customized renewal adjustments, and ending unprofitable contracts. Connecting AI to accounting APIs replaces reactive service workflows with data-driven oversight, allowing a business to scale its operations without increasing administrative overhead.